broader end of the market, which is under pressure. Let's welcome on board Samir Dalal as well and find out what he's making of the market right now. Samir, hi, afternoon. While we're still awaiting and counting down to the life highs for the Nifty, but do you sense that there could be that jugglery which could happen perhaps a little bit out of mid and small caps into large caps right now?
So if you ask me, that's already happened, right? Given the fact that large cap has been rallying while your mid and small cap are getting butchered, tells you that more money is moving to safe havens or, people wanting to secure their, downside rather than focus more on the upside. Because when you have more people chasing the upside, that's when your mid cap and small cap start getting attractive. So I think that what you said is already beginning to happen. I'll be very frank here, and I hate to be the bearer of negative news, but every time we've seen this in the past when large caps continue to move up and the breadth of the market narrows like this, we've seen a sharper correction come through first in the small and mid caps, and then the large cap follows that trend. So could it be an indication of something that has to come? I'm not saying it is going to be an indication, but the fact still remains that valuations remain high even after such sharp corrections in the small and mid cap. Many of them are trading at 30 to 50 times earnings. In the large cap, also stocks are trading expensive. Stocks like HUL, Asian Paints. I mean, if you go through the entire basket trend, which is now in the index, all of these are still trading well above 50 times earnings, and that doesn't put comfort when you look at it into the market. So, if you look at it on the blended basis, yes, the valuations don't look as expensive. They look on a consolidated 22, 23 times earnings. But then you also have to factor in there are certain sectors like banking and all which don't trade above. I mean, they don't look at price to earning, but they focus more on price to book. And if you look at that, if you take out that part of the PE multiple and you assign a price to book, then the valuation multiples kind of continue to look high.
For taking a position in some of these companies, give us a sense of that.
Okay, so I honestly haven't studied the label in that much detail, and I won't know exactly what impact it's going to have on them. But what I can tell you about the segment, so the food delivery segment, we remain extremely optimistic and positive, given the fact that most of these companies have broken into the profitability into black, and as the scale keeps increasing and the operating leverage keeps coming through, I think profitability will keep increasing. The problem we have is purely on valuations. So although the operating leverages are very strong, for justification of some of the valuations, I think the profits need to grow at least 5x from the current level, especially for something like an internal. For Swiggy, it'll be even higher. Before we can say that there's some rationale behind, investing in the stock. You can't keep looking at price to sales only all the time. You have to look at what earnings come through in the space. So that is where we have a stumbling problem. Would we like to invest in these companies, both Eternal and Swiggy? Yes, we would. We already have some amount of stake. We'd like to increase it. We're not selling out because we are very long-term, very positive. So sometimes you have to go through a period of pain. But would I recommend someone to buy either of these at these levels? Swiggy, if it comes closer to the IPO price, yes. Eternal, I would want to say closer to 220 or 200 is where we have comfort levels. But on how the impact of these labor laws are going to affect, I haven't studied in that much detail, but I think most of these will eventually have to be passed on to the end customer, and it's not going to be Swiggy and Zomato that bear the cost.
Kunal, this sharp spike on Swiggy, what does that indicate? And then Zomato, the fact that it's not really been able to resurrect. Yes, there was that knee-jerk reaction when the stock did sink sub that 300 mark, which it did last week as well. From there, it's resurrected, but just about floating around 301.
Yeah, I think it tells that the markets are looking beyond this news flow for both of these stocks. So yeah, on the short-term charts also, if you look at the last 1 week, 10 days of price performance, for both of these names, Swiggy closer to 400 mark, 3D5, I think has formed a double bottom support. Zomato Eternal at current levels closer to, I think, 290, 295, which is again the low the stock had made today. It's more like a double test towards that kind of a support. So which means we are looking at some solid demand territory being reached by both of these names. You might see one case, one of those days where one stock manages to see a bounce, then the other one more of an outperforming stock. But then eventually, I think if these stocks hold on to their support levels, you could probably expect that these stocks may just about go into a time-wise consolidation, form a bottom for themselves, and then eventually start to get into an uptrending mode. So I believe as of now, the first territory where these stocks have taken support are closer to 290 for Eternal and closer to 370, 385, 400 for Swiggy.
Okay, so interesting. That's broadly the pattern. Honeywell is up 8.4%, Kunal. What's the take there and what's happening?
Yeah, I was looking at the charts earlier also, and the stock seems to be coming out of a major corrective wave. Now, the last 3 or 4 months, the stock has fallen very sharply from 42,000, 42,500 to almost 35,000 levels where it's traded right now. And when you look at this in comparison with 2024 highs, where the stock was almost 60,000, and from there the stock had corrected towards 35,000 mark. So it's more like a 40% plus kind of a correction for a stock like Honeywell Automation. And it seems like maybe the stock is trying to form a bottom over here where the demand is getting a little bit more stronger. The risk reward starts to look attractive at current levels. These are not typically high beta stocks which you keep expecting that these stocks may perform 8%, 10% in a matter of few days. These stocks, they have a habit of going to a gradual uptrend, but till the time the previous swing lows are not broken, then I believe the trend could be solid for these names. So as of now, we'll wait out for a point where stocks like Honeywell Automation doesn't break below the previous supports. The nearest support for the stock is at 34,000 mark.
And Samir, by any chance, do you like cement at this point? It's not a sector which we talk about too often, but it's the obvious play. Infra plus the monsoon behind us with likely orders coming through and strong execution, large order books that companies are already sitting on. This could well be the play, right?
Yes, absolutely. I think demand for cement is only going to remain strong going forward, given the fact that two things. So, cement, the largest demand of cement comes from real estate, and you see the kind of pre-sales that a lot of these companies have done. Obviously, now the construction work for all these pre-sales has to continue to happen. So, demand for cement is going to remain robust going forward. The infra side also, like you rightfully said, infra books are large. Government is continually looking at doing more infra projects, roads, ports, blah blah blah, the works. So all of that is going to see demand remain strong. Where the problem lies is the benefits of operational utilization has not come for these companies because these companies have been constantly adding capacity across the board. So I don't deny the fact that it's a very consolidated market on the larger end. I think almost 60% of the capacities with the top five players in India. So they control a large chunk of the market, and hence the pricing is kind of to some extent controlled by them. But unless these utilizations move up to 85, 90%, it becomes difficult for the profitability to increase, because if you keep working at 70% utilization, you're never going to be able to get the benefits of all of the capacities that you put in. So we continue to like cement from a longer term perspective. We think it's a great opportunity. Corrections in stocks have also come. I think Ultratech's corrected from 1,300 to 11,500. ACC Ambuja are down quite significantly from the high. In fact, ACC is trading closer to the bottom 52-week low, if I'm not mistaken. Ambuja too is trading at its low. So opportunity is right. Problem only simply we need to see utilizations going up. How will that happen? I don't have an answer in the short term, but if you have a 3-year view, these are good investments to make absolutely at this point of time.